let's just go to that continuum right now, Lizanne. Are you gloomy like Morgan Stanley, or are you more optimistic like Mr. Cass of Seabreeze?
You'd have to qualify that with a time horizon. I think we're not out of the woods.
3 years. Schwabian 3 years.
Oh, well, if you give me a 3-year time horizon, I'm almost always going to be optimistic. I think.
Right.
First of all, to quote Chuck Schwab himself, investing by its nature is an act of optimism. And if you have a long enough time horizon, you ought to be optimistic, or you probably shouldn't be an investor. And it is funny. We wrote our 2023 outlook a few weeks ago, and when you write outlooks, you're forced to put it in calendar year terms, even though the market doesn't care a lick about the calendar. The economic cycle doesn't care a lick about the calendar. So it was more of a weaker first half, stronger second half, but I don't know if it works out as cleanly as that. I would agree with Mike Wilson. I think the deterioration in earnings estimates for 2023 is somewhat already under the way. You were up at around 250 or so in dollar terms. You're now down to 230. But I think we're probably moving to well below the estimate for 2022, which is 218. So I think very soon we're going to be in negative year-over-year growth territory for earnings, and I think there's more downside than upside there.
Lizanne, I look at exponential moving averages, 3 of them, and they've come to a point for the first time since 2018. It really shows a market with some form of moving average study that's in the doldrums as well. How should individual investors, and particularly with retirement plans, invest given doldrums?
Well, it depends on who you are as an investor. The one beneficial thing that's happened throughout this very tough year, where you lost money both on the equity side of things and on the fixed income side of things, is that you actually have income in fixed income now. You guys talk to my colleague Kathy Jones all the time, and I think there's opportunity for those investors that are income oriented to not have to be way out the risk spectrum like they were forced to be when you were in a ZIRP kind of environment. I also think with the return of the risk-free rate, price discovery is kind of back in vogue. Fundamentals are getting reconnected to prices, and I think the biggest leadership shift that has happened this year is not so much tech to energy, but it's been mega cap to the average stock. And I think that active is operating on a more level playing field with passive. Equal weight outperforming cap weight. Factor-based investing makes a lot of sense. So for the equity-oriented stock pickers out there, those would be the areas I would focus on. Take more of a factor approach than an index approach.
This is really important, folks. And Stuart Kaiser of Citigroup alluded to this yesterday, is when you get into these doldrums, your choice set comes down, comes down, comes down. Is there a value, Lizanne, to a more focused, less diversified approach?
Not necessarily. In fact, if taking an active stock picking approach, you're actually moving away from some of the concentration and lack of diversification that comes when you take a more passive approach. I also think that there's an opportunity here to allow for international representing actually a diversifier, again, speaking specifically of the equity side of things. And not that one quarter that isn't even over makes a trend, but MSCI EFA is pretty handily outperforming U.S. averages. This is not a message to dump all your U.S. equities, back up the truck and load up on international, but either from lack of rebalancing or just recency bias, I think investors have not been at all exposed, or maybe only to a minor degree. And I think there may be an opportunity for diversification both within the equity asset class, but also externally with some non-U.S. exposure as well.
Lizanne, I'd love to talk about this a little bit more. The recency bias, I think we've all been conditioned by the U.S. outperformance and mega cap tech outperformance of the last decade or so. When you have this conversation with clients at the moment, Lizanne, just how receptive are they to this message that you're trying to send?
They're receptive when you actually give them the details of how cycles work. And when you go through what I like to call a dual cycle, where you have a bull market, you go into a bear market, you eventually pull back out again. If there is a corresponding overlapping recession, and let's just posit we're either in one, I think we're in a rolling recession, or we're going to get one, that's a dual cycle. When you come out of those dual cycles, you've never not seen pretty meaningful leadership shifts. And one of the key ones that you see is, US versus non-US. And we think the setup may be there for some non-US. So when you show the data and history and charts and how cycles work, there's a little more up and down nodding of the heads. But initially, it's more of US is the only place I need to be.